welcome back to a new day with a new video. So today we are going to talk about okay the term bank, banking and banker. Bank is any financial institution that receives, collects, transfer, pays, exchanges, tends, invests, or safeguards money for its customers. In other words, bank is the financial institution that collects society's surplus each and gives a part of that as loan to investors for earning profit. So a bank is an intermediary institution that makes relationship between the owner of surplus savings and the investor of deficit capital. In this process, banks earn profit by receiving interest from the borrowers who want to take short-term or long-term and making relatively lower interest payment to the depositors for providing their funds for use by the bank. By honoring the demand of time, banks are using various types of credit products in this way. The risks associated with the uses of paper currency of metallic coins improperly managed. According to Professor Karen Cross, a bank is a financial intermediary dealer in loans and debts. According to Professor Chambers, a bank is an office or institution for the keeping, lending, and exchanging, etc. of money. According to Wood, bank is the trader of money and loan. Bank is an institution that is registered by central bank and mainly perform the following activities. Number 1, receives current deposit. Number 2, discounting notes and approving loans. Number 3, collect checks, drafts and notes. Number 4, act as a trusted and accordant government permission. We can conclude that a bank is a financial institution that receives surplus funds of individuals, trading or non-trading institutions, government or private institution as deposit of supply money with assurance of repayment against security in exchange of profit or interest to trading or non-trading institution. Government or non-government institution who has deficit fund and demand for money, and to facilitate this process create various instruments and give facility of withdrawals of deposit as and when needed. So next is very important, banking. Banking is one of the most important sectors of business and finance that assists the world of commerce to keep on running. Generally, all the activities of a bank is called banking. In a broader sense, banking is the summation of financial services like collection of deposit from people, collect checks, grant loan, transfer money, invest money, safeguards money in the customers, etc. So guys, now take a rest for 1 minute, then we will read our topic again. Okay? So tell me, how's your day going on? I am very busy nowadays for taking your classes, and also my exam is also near soon, my MBA exam. So pray for me, okay? So guys, let's start our topic again. Banker. Our next topic is banker. What is banker and who is banker? The person who performs the banking activities such as accepting of deposits, lending money, withdrawing facilities, exchanging of money is known as a banker. In other words, the person who directly related with the banking business is called banker. Banker manages all the activities of a bank. According to British Stamp 1881, any person carrying on the business of banking is a banker. According to Professor Crowley, a banker is a dealer in debts, his own and other people. According to Gilbert, a banker is a dealer in capital, or more properly, a dealer in money. Banker includes a body of persons, whether incorporated or not, who carry on business of banking. So guys, I hope that you can understand the difference between banking and a banker. These three are different: bank, banking and banker. These 3 points are different with one another. I hope and I wish that you can easily understand these 3 types of part. And if you have any hesitation or if you have any questions in your mind, then inform me. I will try to explain or I will try to solve that question of yours. Okay. So our next question is type of banking. There are various types of banks which operate in the world economy to meet the financial requirements of different categories of people engaged in agriculture, business, profession and more. Top 7 types of banking are group banking, chain banking, branch banking, unit banking, mixed banking, investment banking, universal banking and retail banking. The term banking may define as accepting of deposit of money from public for the purpose of lending or investment of that money, which are repayable on demand or otherwise and withdrawn by check, draft to order. Group banking, a plan offered by banks designed to be used by groups rather than individuals. A common example is a company plan offered to employees. Usually the bank will offer incentives such as discount, lower fees and interest rates, as well as other benefits not available to individual customers. Sometimes bank gives us discount or increase the interest rates for attract their customers, right? And they actually really successful in this matter. If bank increases their interest rate, then people will very agree or they will try to deposit their money in the bank. Thus they can earn more profit, and from that people's money bank was also earn more capital or profit more money. So it is really very helpful. Bank loan is really very helpful because bank loan, some people has no sufficient balances but they would like to create a new business or they have new ideas of new businesses but they don't have any capital. Bank helps them to start up their business and do their grow up their business properly. Bank helps them thus that people can grow their business more with the sufficient money which he or she take loans from the bank, and he can shine on his or her business. So this is really very good things of a bank. Bank helps to the new beginner or new startup who will like to start new businesses. So guys, we will now talk about in our next question. What is our next question? Chain banking. This is my personal hand note. Okay, here I explain different banking topics very easily for you. I hope and I wish that you can understand very easily. Conceptually, chain banking refers to a form of bank governance that occurs when a small group of people controls at least three banks that are independently chartered. Chartered, usually the controlling parties are majority shareholders or in the hands of interlocking directors. The concept of chain banking is different from group banking in that the entities involved in the chain bank arrangement remain autonomous and are not owned by a single holding company. Mixed banking. While this type of banking promotes rapid industrialization, the mixed banking system reduces the liquidity of funds of commercial banks. Stated differently, it differs to this is because funds get blocked when the bank gives long-term loans to industries. Unit banking systems encourage either small independent banks or banks that are theoretically independent but are in fact owned by a bank holding company. Advantages of unit banking: local funds for local people. The unit banking is a particular locality utilizes its resources for the development of its own locality only and does not transfer them to other localities like branch banking. Intimate knowledge of customer. The managers of the local unit bank can easily acquire the personal knowledge of customers as well as the specialized knowledge of the local industry and occupations. Therefore, he is in a better position to serve the need of the individual exploiter of his locality. Continent management, supervision, and control. Discontinuance of inefficient branches. Branch banking. Branch banking refers to a single bank which operates through various branches in a city or in a different location or out of the city. It offers a wide array of face-to-face service to its customers. Investment banking is a specific division of banking related to the creation of capital for other companies, government and other entities. Investment banks underwrite new debt and equity securities for all types of corporations, aid in the sale of securities and help to facilitate mergers and acquisitions, organizations and broker trades. Guys, don't need to be scared. Electricity go, but our study will be continue. Okay. Sorry for bad this problem. Actually, I don't have any clue where this electricity gone this time, but this class will be run. Don't worry about that. Investment banking. Investment banking is a specific division of banking related to the creation of capital for other companies, governments, and other entities. Investment banks underwrite new debt and equity securities for all types of corporations, aid in the sale of securities, and help to facilitate mergers and acquisitions, recognitions, and broker trades for both institutions and private investors. Investment banks also provide guidance to issuers regarding the issue and placement of a stock. Universal banking, a type of banking that combines the aspect of both investment banking with commercial banking, thus allowing these banks to offer a much wider variety of financial options to their customers. Universal banking is a banking system in which banks provide a wide variety of financial services, including commercial and investment services. Universal banking is common in some European countries, including Switzerland, United States. Banks are separate their commercial and investment banking services. Proponents of universal banking argue that it helps banks better diversify risks. Detractors think dividing up banks' operations is less risky strategy. Retail banking. Retail banking, also known as consumer banking, is the provision of services by a bank to all general public rather than to companies, corporations, or other banks, which are often described as wholesale banking. Banking services which are regarded as retail include provision of savings and transactional accounts, mortgages, personal loans, debit cards, and credit cards. Retail banking is also distinguished from investment banking or commercial banking. It may also refer to a division or department of a bank which deals with individual customers. Different modern banking system. Number one, I already talked about. So, important banking system in the economic development of Bangladesh. Bank accepts deposit and make loan and derive a profit from the difference in the internet financial intermediation. Through the process of financial intermediation, certain assets are transformed into different assets or liabilities. As such, financial intermediaries channel funds from people who have extra money or surplus savings to those who do not have enough money to carry out lend-wise, not other things. Don't worry. Capital formation. Capital formation is one of the determinants and banks promote capital formation. Capital has three well-defined stages: generation of savings, mobilization of savings, canalization of saving in productive use. Banks plays a crucial role in all three stages of capital formation. Encouragement of entrepreneurial innovation. I already said about it that bank encourage those innovators or those start new businessmen who are like to create a new businesses. Bank encourages them, all of them. In undeveloped countries, entrepreneurs generally hesitate to invest in new ventures and undertake innovation largely due to lack of funds. Facilities of bank loans enable the entrepreneur to step up their investment and innovation activities, adopts new method of productive capacity of the company. Monetization of economy. Monetization of the economy is essential for accelerating trade and economic activity. Banks, which are creators or distributors of money, allow money to play an active role in the economy. They help the process of monetization in two ways. They monetize debt, in other words, they buy debts by spreading their branches in the rural and backward areas. The banks convert the non-monetized sectors of the economy into monetized sector. Credit provision. Credit fuels economic activity by allowing businesses to invest beyond their cash on hand, households to purchase homes without saving the entire cost in advance, and government to smooth out their spending by mitigating the cyclical pattern of tax revenues and to invest in infrastructure projects. Liquidity provision, this is very important. Business and household needs to have protection against unexpected needs for the cash. Banks are the main direct provisions of liquidity. Withdrawn at any time, offering lines of credit. Further, banks and their affiliates are the core of the financial markets, offering to buy and sell securities and related products at need in large volumes with relatively modest transaction costs. Risk management services. Banks allow business and households to pool their risks from exposures to financial and commodity markets. Remittance of money. Cash can be transferred easily from one place to another and from one country to another by the help of a bank. It has facilitated transaction in distant places. This is turn has expanded the internal rapid economic development. The banks make available loans of different periods of agriculture, industry and trade. They make direct investment in industrial sectors. They provide industrial, agriculture and commercial consultancy, hence facilitating the process of economic development. Promotion of entrepreneurship. The role of private sector is crucial in accelerating the pace of economic growth. The banks increase the participation of the private sector in economic development by making available the loans easily on reasonable rate of interest. The expansion of financial sector encourages entrepreneurs to make investment by promoting entrepreneurship. Implementation of monetary policy needs an appropriate monetary policy, but a well-developed banking system is a necessary precondition for the effective implementation of the monetary policy. Promotion of trade and industry. Economic progress of the industry advanced country largely depends on banking system. The use of bank check, the bank draft, and the bill of exchange has revolutionized the industrial and international trade, which turn has encouraged specialization and accelerated the pace of industrialization. Service sector financing. Development of a country largely depends on the development of service sector like hotels, restaurants, housing and real estate, etc. Banks are very dependable sources of financing this sector as well. Import and export financing. One of the most important activities of the banks is import and export financing. We know that all the countries of the world need to import their requirements and export their surplus. Banks, by a mechanism of letter credit, render useful services to both the importer and exporter of goods and ensure payment if contractual obligations are met. So, guys, I hope you can understand this banking chapter very clearly, and I think that you don't have any questions about this chapter. So, what will you learn in next? Comment below on this video. I will try to explain that question of yours in my next class.